To a tremendous extent, outstanding real-life investment success doesn't rely on doing anything particularly brilliant, but rather avoiding the big mistake. It's not about the number of great shots you hit, but rather the fewest really terrible shots. There are 8 great mistakes, 8 Hydra-like heads growing out of the body of the big mistake. None of them is objectively worse than the other, but the most dangerous one is the one that you're winding yourself up to make right now. Of these 8 great mistakes, some of the 8 great mistakes are made simultaneously. A few of them are made one right after the other. The first of the 8 great mistakes is over-diversification. Now, you don't see this one a lot because it's an individual thing rather than a crowd phenomenon. Let's say an investor funds their 401k annually, and each year they buy the highest rated equity mutual fund listed on the Forbes honor roll. So after 12 years, they own a hodgepodge of 12 different mutual funds because, like Miss America, nobody wins twice. By having neither a philosophy or a strategy for carrying it out, our investor now owns the world's largest, least efficient, most expensive index fund with gaps, redundancies, and fee inefficiencies. By whatever means the over-diversified investor gets there, in an effort to own everything, they own nothing. The second great mistake is under-diversification, the narrowing down of a portfolio to essentially one idea, the conviction that we're either at the dawn of a new era or facing the end of the world. Another iteration of this great mistake is the over-concentrated stock position, loving a stock that will never love you back, in the vain belief that your love renders you immune from the law of creative destruction. It does not. Great mistakes number 3 and 4 usually follow one another. The third great mistake is euphoria, which is often mislabeled as greed, but it's the perception of risk being that other people are making more money than I am. Panic usually follows episodes of euphoria and is generally as deep as euphoria was high. It manifests as the unconscious belief that somehow the curve of equity returns has been forever broken. This psychology begets the impulse to capitulate at any price. Sell me out, get me out, I gotta get out of the market. The fifth great mistake is leverage. And leverage is the wrong loan at the wrong terms, at the wrong time to do the wrong things for the wrong reasons. The sixth great mistake is speculating when you think you're investing. This is putting money into a miracle at the prices that the venture capitalists charge public investors who are rushing to cash in on a bonanza. It's helpful to remember that venture capitalists always see you as an exit strategy. The seventh great mistake is investing for high yield instead of total return. It's the classic retiree's mistake. Helpful to remember that the relationship between current yield and long-term total return is always inverse. Always invest for total return. The eighth and final great mistake is letting your cost basis of an investment dictate your investment strategy. What you paid for an investment, those are sunk costs. It has nothing to do with someone else will pay you for that investment today. Your investments don't know what you paid for it. They wouldn't behave any differently even if they did know. So there are the 8 great mistakes. Each and all of them are behavioral. They are things that investors do that they shouldn't do. So if you find yourself inclined towards one of these behaviors, I encourage you to take a step back, take a deep breath, talk to a dispassionate third party, perhaps your financial advisor, because your ultimate financial and investing success is not going to be just the things that you do, but it's going to be the things you don't do.